How to begin your investment property journey? That is a very good question. Hey everyone, and welcome back to The Wealth Expert. If you're looking for ways to build wealth and generate passive income, then this video is for you. We're talking about how to begin your investment property journey, a great way not to only grow your overall wealth, but also create financial freedom. Whether you're a seasoned investor or just starting to dip your toes into real estate, knowing the right steps to take, the financing options available, and the potential risks involved is essential. In this video, we'll break down everything you need to know, from financing your first property to the benefits and challenges of real estate investing. And remember, if you have any financing questions, please email me at paul.welch@millionplus.com, where my team and I are here to help you. What we'll look to do with these financing opportunities and questions is to help you secure the right property investment funding. Why should you invest in real estate? Real estate has long been a popular choice for building wealth, and it offers a few unique advantages. First, there's appreciation. Over time, real estate values tend to increase, which means you could potentially sell your property in the future for a lot more than you paid for it. This provides what we call capital gains. But it's not just about selling your property. While you're holding on to it, real estate can generate a steady stream of passive income through rental payments. Many investors use this rental income to cover their mortgage, property taxes, and even repairs, leaving them with a nice profit each month. That's not always guaranteed, so it's really important to do your maths and understand the highs and lows of cash flow with property. Now, one of the biggest advantages of real estate investing is the ability to use leverage. With leverage, i.e. borrowing money, you usually do this through a mortgage to purchase the property, which allows you to amplify your potential returns. Essentially, you're using other people's money to grow your overall wealth. And if that wasn't enough, real estate also acts as a hedge against inflation. As inflation rises, so do rents and property values, helping you maintain your purchasing power. So while other investments might lose value in inflationary periods, real estate has the potential to increase in value. Now, before you start collecting rent or watching your property appreciate, you need to figure out how to finance your first property. And believe me, your financing strategy can make or break your entire investment. Let's walk through some of the common financing options you have. The first, and likely most familiar, is the conventional bank loan. Conventional loans are what most people use to finance their own homes, which is a residential mortgage, but in this case it's an investment or buy-to-let mortgage. But they work a little differently when it comes to investment properties. For starters, banks typically require a larger down payment or deposit, around 30% or more depending on the property's value. In some cases you can find smaller deposits, but the rental yield will invariably determine how much deposit you need. That's because lenders see investment properties as riskier than primary residences. And it's not just the down payment that's higher. You'll also need a solid credit score and proof that you can cover the mortgage even if the property isn't bringing in rental income right away. Lenders want to make sure you can afford it even during those vacancy periods when you might not have tenants. Next, let's talk about hard money loans or bridging loans. Now, these are a bit different. They're short-term, high-interest loans typically used by people who are flipping properties, buying, fixing, and then selling them quickly for, one would hope, a profit. A hard money loan or a bridge loan or bridging finance is based on the value of the property and your exit strategy, and in some cases the after repair value can be taken into consideration. Your credit score doesn't impact this, and it's often faster to qualify and to arrange this type of finance. Bridging loans and hard money loans can be incredibly useful if you're in a hurry or if you don't meet the strict criteria for a conventional loan. But there's a catch. They come with higher interest rates, sometimes as high as 18% and other times as low as 10%, and they usually need to be repaid within a 12 to 18 month period. So if you're not flipping the property, this might not be the best option. So therefore, as always, it's super important to seek professional advice when arranging these type of loans. If you have friends or family who are willing to invest in your property journey, you could look into private money loans. These are loans that you can negotiate directly with your family members or other individuals, and the terms can be a lot more flexible. The downside, things can get messy if the deal goes south, so always ensure you have everything in writing. If you need us to introduce you to a good lawyer, we know a few. Another option for those of you who already own a home is tapping into your equity. To remortgage and access equity in your property, you can borrow against the value of your primary primary residence to finance your investment property. These loans often have lower interest rates than conventional loans because they're secured by your main home. But be cautious, you're putting your house on the line. And remember, if you have any questions about the best financing strategy for you, then please do reach out to us either at email at paul.welch@millionplus.com or give us a call on 0207 519 4950. We have a team of experts that can help you with either residential mortgages or investment ones, depending on what you're looking to do, to help you secure the funds that you need to make your investment dreams a reality. If you have other assets like single stock, Bitcoin and shares, portfolios of investments, then there may be other ways, which is like a margin loan or a blended loan or a Bitcoin loan or single stock loan, that can also be considered. These also require expert professional advice, so please ask. So now that you know how to finance your property, let's talk about the next steps to get started. First things first, you want to assess your finances. This might sound basic, but knowing exactly how much you can afford to spend up front will save you from overextending yourself down the road. Think of it like this: real estate investing isn't just about coming up with a down payment. You also need to account for closing costs, property taxes, maintenance, legal fees, and those inevitable unexpected expenses like a burst pipe or a boiler replacement. That's why it's so important to have a financial cushion before proceeding. Next, it's time to research the market. Not all real estate markets are created equal. Is the area you're looking at growing? What's the demand for rental properties? Are home prices on the rise, or is the market oversaturated? Are there any repossessions or auction properties to enable you to buy at a discount? The more you understand about a market's potential, the better your chances of success. Once you've done all of your homework and you know where you want to invest, it's time to secure the financing by making an application. Whether you're going with a conventional loan, bridging finance, or tapping into home equity, or getting some help from your friends or family, make sure you shop around for the best rates and terms. And for those of you getting started, I'd recommend beginning with a single family buy-to-let type property. They're easier to manage than multi-family units, which are known as HMOs, and are either 3, 4, 7 flats in one unit. Single units are easier to start your investment journey, and they tend to attract more stable tenants. Benefits and risks of real estate investing. Let's talk benefits first and then risks. Real estate investing has the potential to create steady income, capital appreciation, and even tax benefits. For instance, as a rental property owner, you can deduct mortgage interest, property taxes, and even certain repairs. And if you're savvy, there are various strategies when working with tax advisors which help you potentially defer capital gains tax when you sell one property and reinvest the proceeds into another, but you need expert advice from a tax lawyer. That said, investing in property isn't without its risks. One of the biggest challenges dealing with rental voids or vacancies. If your property sits empty for a few months, that's lost income. You also have to factor in maintenance and unexpected costs, which can add up quickly. Managing tenants can also be stressful, which is why some investors choose to work with a property management company. They'll take care of everything from tenant screening to repairs, but it'll eat into your profits. It's all about finding the right balance for your goals and lifestyle. So there you have it, the key steps to begin your investment property journey. Real estate investing can be an incredibly powerful tool for building wealth, but it's important to go into it with a clear plan and the right financing. If you enjoyed this video and learned something valuable today, please be sure to like this video and subscribe to the Wealth Expert channel. And don't forget, if you're looking for expert advice on financing your investment properties, please get in touch. Thank you so much for watching, and I hope you join me on the next one.